Hello and welcome. Today, we move into the very heart of the accounting process. We are going to learn the formal language that accountants use to record business transactions, the language of debits and credits. This is a foundational skill, and mastering it will unlock your ability to understand how financial statements are truly built from the ground up. Here is our agenda for this session. First, we'll discuss why we need the terms debit and credit. Then, we will master the rules of debits and credits for all account types. From there, we'll learn the two key parts of the recording process: how to create a formal journal entry and how to post that entry to the ledger using T accounts. Finally, we'll learn how to perform a final check on our work by preparing a trial balance. You might be wondering why we can't just stick with increase and decrease. The reason is that accounting needs a standardized universal system that works for all accounts, and that system is built on two simple terms derived from Latin. A debit simply means the left side of an account. A credit simply means the right side of an account. It is critical to understand that these terms do not inherently mean increase or decrease. Their effect depends entirely on the type of account we are looking at. Let's begin with the rules for assets. As you can see from the T account, the left side is the debit side and the right side is the credit side. For assets, the rule is straightforward. You debit the account to show an increase and you credit the account to show a decrease. So, to increase an asset, you debit it. To decrease an asset, you credit it. Now for liabilities and stockholders' equity. These accounts are on the opposite side of the accounting equation, so their rules are the opposite of assets. As you can see in these T accounts, to increase a liability or an equity account, you credit it. You enter the amount on the right side. To decrease them, you debit them by entering the amount on the left side. Remembering these rules can be tricky at first, so we use a very helpful mnemonic, DILR. DIA stands for dividends, expenses, and assets. All of these accounts are increased with a debit. LOR stands for liabilities, owner's equity, and revenue. All of these accounts are increased with a credit. If you can remember DLOR, you will always know the normal balance of an account and how to increase it. This master diagram brings everything together. It shows how the debit and credit rules apply across the entire expanded accounting equation. You can see the DEA rule at work. Assets, dividends, and expenses all increase with a debit on the left. And you can see the LOR rule. Liabilities, common stock, which is part of equity, and revenues all increase with a credit on the right. This is your ultimate reference chart for transaction analysis. Now, let's put these rules into practice. The first step in the recording process is creating a journal entry in the journal. Think of the journal as the official diary of the business. It provides a complete chronological listing of every transaction. The most important rule of the journal is that for every single entry, the total amount of the debits must equal the total amount of the credits. A journal entry has a specific format, much like a sentence in English. You must include the date of the transaction. The account that is debited is always listed first, against the left margin. The account that is credited is listed second and is indented to the right. The debit and credit amounts are placed in their respective columns, and a brief description is usually included to explain the transaction. While the journal gives us a chronological list, it's not very helpful for finding the balance of a single account. For that, we need the general ledger. The process of transferring the information from our journal entry to the individual accounts in the ledger is called posting. The general ledger is simply a collection of all the individual accounts for a company. For our lessons, we will use a simplified version of a ledger account called a T account, which helps us visualize the debits and credits. Let's walk through a full example. Eagle Soccer issues stock for $200,000 cash. First, we analyze what happened. Cash, an asset, increased, and common stock, an equity account, increased. Next, we apply our dealer rules. To increase an asset like cash, we debit it. To increase owner's equity like common stock, we credit it. Now we create the journal entry based on our analysis. We date it the 1st of December. We debit cash for 200,000 and we write a credit to common stock, indented for 200,000. We include a brief description that we issued common stock for cash. Our debits equal our credits. The final step in the process for this transaction is to post the amounts from the journal to the general ledger accounts. As the arrow shows, the 200,000 debit to cash from our journal entry is transferred to the debit or left side of the cash ledger account. After this entry, the cash account now has a balance of 200,000. After we have journalized and posted all of our transactions for a period, we perform a final check to make sure the books are in balance. We do this by preparing a trial balance. A trial balance is simply a list of every account from our general ledger and its final debit or credit balance. Its entire purpose is to prove that the sum of all the debit balances equals the sum of all the credit balances. This is an absolutely essential step before we can prepare the financial statements. So, let's recap the process we learned today. For every transaction, we first analyze it and record it as a journal entry in the journal. Second, we post the debits and credits from the journal entry to their respective T accounts in the general ledger. And third, at the end of the period, we prepare a trial balance to ensure our total debits still equal our total credits. This systematic process ensures accuracy in our accounting records.